Well, welcome to the first 2024 get together of we used to be called the Three Musketeers. Now I think my wife has mentioned us in the term of the Three Mouseketeers. I don't know what that really means, but Happy New Year to you and to all of our folks that are joining us. Some of you are here for the first time, so I think I just want to take a half a second and introduce myself. I'm Paul Merriman. I founded this organization about 11 years ago, the Foundation, Financial Education Foundation, and our goal, mission is to teach do-it-yourself investors to do it better. That's what we're all about. And here with me, one of the powerhouses behind doing it better is Chris Pedersen. Chris has been with us since 2016 and developed the Two Funds for Life strategy and put together the best-in-class ETFs. He's been so valuable to helping the folks that follow our work do it better. And Daryl Balls, Daryl, what year did we start working together? Do you remember?
I would say maybe 2015, 2016, okay. Something like that.
And we had been friends for 20 years, I think, prior to that. But your work and putting together, I think, over 200 different tables that you update each year now. We have people clamoring right now, wanting to know when are the tables going to be out.
But I have to wait for the data. I need the
data. I know that's what but I say it so nicely that. Yeah. but the bottom line is, the three of us and a team of other people who support us, we are here to try to help you be better at this process of investing. And we're here to find ways to help the first-time investor, and we're here to help the people who are just coming into retirement, and then finally those who are in the final years of their lives and are trying to figure out what they can do for others in their family. We are not financial planners. We are focused purely on the process of investing. So what we do with these meetings, and I think we meet about once a month to take some questions and maybe to discuss things that are on our mind about topics that we think you'll be interested in. And of course, the thing that people tend to be most interested in is performance, and the performance that we've helped people get in the last year has been good. I'm sure that people who missed out on the cryptocurrency move are wishing they hadn't listened to us when we said, no, that's a speculation, that's not an investment. Still feel that way, even though it is now becoming recognized as it's available through an ETF and other ways that are going to continue to make it legitimate at the same time as it is still a speculation, not an investment. But Chris, you've done some marvelous work that I think we should spend some time talking about here today, because a lot of folks may not know about the work that you have done in putting together the configurator. And how about taking a few minutes here and describing the work that you've done and the lessons that have come from it for you, and then we'll talk something about the performance of these strategies that you're going to introduce to a lot of people who are new.
There's also some new functionality that just got added to the configurator. So I think it will be a fun thing to take a peek at. And I know that some people in the audience have already been peeking at it, because when I'm working on it, I can see that other people are logged in.
Oh,
And so it's kind of fun to know that there's a little bit of interest out there. The way you get to the configurator on the website is you come up here to portfolios, and then you go down here to portfolio configurator. Once you're in the portfolio configurator and you've got these instructions over here, it's pretty simple. And what it does is it helps you learn what funds you might want to use to implement one of our portfolios, and also what characteristics the portfolio using those funds is going to have. And you can look at these individually or as a family. So let's just follow the instructions and see what we get. Let's say that you wanted to use a worldwide 4 fund that's 70% US and 30% international. Well, you would look in the list and click on that one. And immediately, one of the things you see is that it eliminated here on this chart that shows you can think of it as a picture of how value-y the portfolio is, or how discounted the equities are inside, and also how big the companies are. Immediately, a whole bunch of dots went away, and you're just left with these here in the middle. And so you can see that these portfolios, they range from one that's bigger and less value-y, implemented with Vanguard mutual funds, to one down here on the left that is smaller and more value or cheaper, implemented with the best-in-class ETFs. So you can already start to see how your choice of the funds that you're going to make later on is going to impact the outcome. But let's continue just with the instructions. So we've got the worldwide 4 fund, 70% US, 30% international. We're going to say we're going to do that in a tax-deferred account. And I'm not going to add any fixed income initially. You could later. And then we'll choose the best-in-class ETFs. And as soon as you pick the fund family, it brings up over here on the right the actual funds that we recommend, as well as the percentages that we recommend for implementing the portfolio that has the characteristics you chose over on the left. So it's a worldwide 4 fund, 70% US, 30% international. And that means it's got some US large cap blend, 35%, US small cap value, 35%, international large cap value, 15%, and international small cap blend, 15%. Now you can add, if you want, some fixed income to that. Let's say we want to add 20% fixed income. And now you see the bonds down below get added in along with the funds, and the equities get reduced appropriately. So you still have that equity portfolio that you chose. But what's new, well, actually, before we leave this, you get some characteristics of that portfolio as well. You can see its expense ratio. You can see the price to earnings, the yield that it produces, or has produced, I should say, over the last 12 months. The US percent, international percent, and emerging markets percent that you end up with. And some people are looking at this going, wait a minute, there's no emerging markets fund. Why do you have 1% in emerging markets? Well, there's a little leakage. These funds are never exactly what the label says. So sometimes an international fund, even though it says international developed, will have a little bit in emerging markets, for example.
And Chris, if I could just enter one point. This is the best in class ETF, and you made a reference. It's a fund family, if you will, but really it is also, these are all funds, ETFs, that are available at Fidelity, at Schwab, at Vanguard, and others. And you have to check to make sure of this with others, but on a commission-free basis. So these are all available at Vanguard, even though these are, you're going to show here maybe in a second, an actual Vanguard portfolio.
Right. We do have a Vanguard ETF portfolio, which I can choose that, and you can implement it with Vanguard if you're really motivated by their low expense ratio. And you notice the expense ratio went down to 0.09% versus best in class, which was 0.2%. So it's cheaper, but you can also see over here that the Vanguard has a price to book of roughly 2.1 and a market cap of 14.5 billion, where the best in class has a price to book of 1.7 roughly and 11.9 as a market cap. So it's more value oriented. You're paying a little bit to get access to those cheaper stocks. And the reason they're best in class is that we believe you're going to make more money because it's more value oriented in the long run by paying that 0.2% for the added exposure to the value factor. But to what Paul was saying, these are all chosen down here in the fund families, not because they're all always from that company. So for example, if I click on Fidelity, you'll see this iShares fund is used for international value. Well, that is a commission-free fund available at Fidelity. So all of the funds, when you pick fund family, are commission-free at that company. And they were chosen to be the best ones available that are commission-free within that fund family. So unless there's any other questions on the basic portfolio configurator, what I wanted to highlight is that I've added additional pages over here on the left. Previously, we had this page called Glossary and Notes that described some of the acronyms that might not be familiar or the abbreviations that we used in the sources of information. But I've just added this page called Two Funds for Life. And it follows a similar kind of structure, but the portfolio strategies on the left are all mixes of a target date fund and a U.S. small cap value fund. The first one is actually a pure target date fund, but the rest are various mixes going with 90% target date fund up to 10% target date fund and 90% in small cap value. And then we have also the choice of the fund year. And since the fund controls the amount that's in fixed income, we calculate the fixed income percentage that you end up with when you choose one of these combinations. And what's interesting...
What do you mean end up with, Chris? Because doesn't it vary throughout the lifetime of the fund?
It does. And I'll come back to that in just a second, Daryl. You'll see. And you can actually see over here on the right how, for example, if you average them all together, this is the glide path you get. But if I pick the target date fund, you can see the equity allocation over here on the right, depending on which retirement year you have chosen. And as soon as you pick a year, like 2040, now you've locked yourself into a specific allocation to fixed income of 23.6%. But if I increase the amount that I've allocated to the target date fund, say I go 50-50, so 50% in a target date fund, 50% in small cap value, now the fixed income percentage in that total portfolio goes down. Now it's 11.8% because...
But that's right at, sorry. That's right at this particular time. As the fund moves through time, that will change.
Exactly. And if you want to see the whole glide path, then deselect the particular year that you want to use, and you can see the whole glide path now for a 2050. You can see it for a 2080, which is pretty extreme. Most people wouldn't ride that glide path because it only gets you down to 86% in equities. But I think the 50-50, people might actually live with that for a lifetime. And that gets you to a 65% allocation to equities in retirement. If that sounds hot, you could go with a 60-40. That gets you down to a 60% allocation or a 70-30. So you've got these choices. And what is really interesting is now I can take, for example, let's take an 80-20 allocation, 80% in the target date fund, 20% in small cap value. And you can see what the equity portfolio looks like for all of the different time horizons here on our chart of size and value. And now you can go back to the sound investing portfolios and you can see, for example, what the worldwide 4 fund looks like, and you can compare the two. And it's interesting. They're not that far apart. The 2 fund for life portfolios are actually a little bit smaller, and are actually a little bit larger, and the 4 fund portfolios are a little bit smaller, but they both reach into similar kinds of value space. So if you wanted to compare and say, well, what kind of a portfolio might get me close to a 100%, let's look at the ultimate buy and hold with a 70-30, because most of the 2 funds for life are 70-30s. You can pull that up, and you can even select best in class. And you can see where the ultimate buy and hold 70-30 best in class sits. And then you can go to the 2 funds for life and say, well, what might be close to that? And you can deselect this, and you can see, well, it was down around in here. So a 2 fund for life, 70-30 target date fund and small cap value in 2015 would actually be pretty close to that, which is kind of interesting because that's a mature allocation.
Chris?
Which would have more fixed income. So in that sense, they're very different. But in terms of the actual equities in the portfolio, they'd be very similar. Yeah. Did I hear a question?
Yeah. Can you click on one of those meatballs on that chart and select the?
You can.
Excellent.
Yeah. Yeah. So now we can come back.
So you can pick. You can
see that they're pretty close to each other. Yeah.
You can pick where you want to be in the space and click on it, and that'll show you the portfolio that does that.
Right. Exactly. Yeah. So I didn't want to spend too much time on this, but I think hopefully the listeners will find some value in it. And I've included on page 3 my fine tuning table that we talked about in a previous podcast. This one's not interactive, but for people considering 2 funds for life, I think it's a useful reference just to have right next to all the other material that you're looking at. So yeah, that's the update to the portfolio configurator.
And just in case people did not see you discuss this table, I think it would be worthwhile here to just take a few minutes and walk them through this, because here we actually have some performance data that you don't have in the configurator. And correct?
Correct.
Okay.
Yeah, the configurator is there to show you what the characteristics of the portfolio are if you build it with particular funds. And what it doesn't do is tell you how those funds have done in the past or how that asset allocation has done in the past. And what Daryl's back testing and tables do, and what my fine tuning table for 2 funds for life do, is the second part. They say, well, how have these performed in the past? And basically what this table, the 2 fund for life fixed allocation lump sum annually rebalanced fine tuning table, does is very similar to Daryl's tables, except it combines a lot of different portfolios on a single page. And for those who are maybe listening and not watching, across the top, you have different vintages or years of target date funds. So it runs the gamut from all the way into retirement, 7 years or more into retirement, down to 25 years or more before retirement in 5-year increments. And then on the vertical axis, what you get to do is decide, well, how much small cap value am I going to put in this portfolio? So you can go 0% and you're 100% in the target date fund, or you can go 10% in small cap value, 90% in the target date fund, all the way up to a 50-50 allocation to small cap value and the target date fund. And within each of those boxes, then you can see what the historical compound rate of return was. You can see what the worst 10-year compound rate of return was. You can see the worst drawdown going back to 1970, and you can see the 30-year safe withdrawal rate for an approximation of this allocation going back to 1928. So I think it's really valuable because for a young person, they can look at it and say, well, I care not as much about the bumpy ride. I care more about return. That might nudge them, for example, to a 50-50 allocation or even more. For somebody who is a retiree and they want to know, well, what gives me the highest safe withdrawal rate? They can find that with a mature allocation, or maybe they don't care about the safe withdrawal rate. Maybe they want the highest return, and they've oversaved and they've lived a life with tolerating a lot of volatility. They could pick a box that's more volatile. So I think it just lays out a very wide range of choices in equity allocation, small cap value tilt, and fixed income tilt. And it gives people the choice to pick and live in a box, or it gives them the choice to pick a row and let the target date fund move them along if they want, and just continue to use the same target date fund. So I think it's hopefully it's very useful both to young people and old people who want to simplify their portfolios and still get good returns per unit of risk. Yeah.
So let me just do a little exercise here. I'll be speaking to college seniors in a couple of months, and I would certainly want them to put at least 20% in small cap value, and the balance in the target date fund at a minimum. And what I can see here, then, they should, in theory, be thinking that they could get, you've got it here, 10.8% for that from age, let's call it 22 to 40. That would be a reasonable thing for them to think could happen to them. And that the worst 10-year period they would have experienced during that period would have been a gain of 2.6% a year instead of 10.8, right?
Yeah, and I mean that's the history going back to 1970 would suggest those are very reasonable expectations, and they should also expect, not in the early years when their deposits or their contributions are really big compared to the balance, but somewhere along the way, they'll probably experience a 50% drawdown as well. And possibly even more, because going back to 1928, they were deeper.
Yeah.
But one of the teaching principles I hope you bring to them is that the way you earn your return, this is not money for nothing. The way you earn these returns is by bearing prudent risk, by tolerating volatility. You're taking a job, and your job is to ignore the ups and downs of the market and invest in things that have real value and growth in earnings and a high likelihood of delivering you a good return.
And after they've made it through that first 20 years, theoretically, they can see that the next 5 years, instead of 10.8, it's 10.7. And the next 5 years, instead of 10.7, is 10.5. And they can follow what might happen.
Yes.
All the way through to the end of their life, actually, if they wish.
Yep.
We don't have a calculator that allows you to just do that. I don't think, anyway, at this point, that allows you to do that. But at least the basic numbers are here. And as you say, right in that same box is the worst drawdown. And that's what you're signing on for. Again, you make that case well. So I think this is a powerful table. What, Daryl?
In the past. These are all historical data, right, Chris?
Yep. All in the past. The other thing, a young person may have trouble relating to this, but imagine they're coming up on retirement, right? 5 years before retirement, and they really want to know how much money they have to retire on. Well, the target date fund is going to reduce that risk. And if they're in that 80-20 row, then unless small cap value has outperformed by a lot, which it may have, the risk in that box declines to 37%. Now, if they're annually rebalancing, which is the way this chart is built, then instead of 50%, now they're less than 40% drawdown. So there's more certainty in terms of how much money they would have in retirement. And around retirement, when they're starting to live off their savings, it's down to almost 30%. And, into retirement, it's down to 22. So yeah, you can see that ride, and you can see where you might be nervous nearing retirement. The target date fund is trying to pull some risk off the table. And if you find out you've oversaved as you get into retirement, maybe you decide to either increase your allocation to small cap value or go back in time. Pick up one of those target date funds that doesn't mature till later so that you have a higher equity allocation. This chart lets you make all of those decisions with at least some historically meaningful information. Yeah.
And what these young people and older people are going to start seeing more of is some recent research has come out that recommends people be all equity all the time, all of their life. Which I think is in many ways outrageous, and I've fought against that because I'm not sure that people really understand what that's going to be like when that portfolio is down 50, 60, or 70%, but they're going to see a lot more of that kind of research, and so this is really overall pretty conservative strategy, I think. The only thing I'm hoping that we'll be able to convince young people to do is to consider building their own do-it-yourself target date fund so we can further fine-tune this. But I'll tell you, for the people who don't want to spend that extra time, Chris, I think this is a fantastic, terrific piece of work for the young and even middle-aged savers. So thank you.
Yeah, my pleasure.
I did also. I wanted to there was a question that came in that fits nicely right here, and that's, what's the highest return per unit of risk portfolio you've back tested, and why shouldn't we all use it? So actually, Daryl, I think if you happen to have H1 in your pocket, or maybe it's H2
don't right now, but give me a second and I can go find it.
Okay.
You can talk about something else for a minute.
Well, I'll talk about the chart we just shared. The highest return per unit of risk, if you just did something that's kind of like it's not like a Sharpe ratio, but it's close. I mean, it'll still pick the highest Sharpe ratio one. If you just took the compound annual growth rate and divided it by the standard deviation, the highest return per unit of risk is actually a mature target date fund. Just the target date fund.
Tell us about that. Why?
Because it's got a lot of bonds in there. So it gives you an 8% historical rate of return. That's what the compound rate of return was, and the standard deviation was only 6%. So your worst drawdown was 17%. So it's kind of a nervous Nelly portfolio, and that's probably why the target date funds are built the way they are. Is that they realize for people who have saved just enough and maybe aren't really financially savvy and are well into retirement, they just want to know that their money's going to last and they're not worried about much of a legacy. Yeah. And they want to see a stable amount of money in that balance.
Does that suggest that any extra money that came out of the investment that was not the target date fund by itself did not only get a higher return because it took more risk, but it didn't give you a higher unit of return per unit of risk? In other words, it's not perfect for what we would like to think it could be. Is that a fair conclusion?
I think it's a fair conclusion that most of the time, to get a higher return, you're going to have to take more risk.
Right.
Right. That is a fair conclusion. And you may have to take, at least in terms of that way of measuring it, you may have to tolerate more risk than you see in return in just in that ratio.
Yeah.
But another way to look at it, another measure of return per unit of risk is how resilient is this portfolio to sequence of returns? And the proxy for that would be safe withdrawal rate on here. And the safe withdrawal rate for the mature target date fund is 3.5%, but the safe withdrawal rate for the 40% small cap value, 60% target date fund at maturity is 4.9%.
It's a big deal.
So different way to measure return per unit of risk. I mean, I would say you're in less risk of running out of money using that option. So that's a different way of measuring risk. Yeah. And I think that's really why there isn't one recommendation for the highest return per unit of risk, is that your definition of risk will be personal.
Yeah.
Yeah.
Did you find it,
Right.
Daryl?
Right. And yes, I did find it, Paul.
Good. All right. Let's look at the unit of return per unit of risk in these portfolios as we've looked at them. Now, this is the table that shows the return both by decades, during the good years, during the bad years, with the Sharpe ratio and the standard deviation and the Sortino ratio. I mean, it's looking at these combinations of equity asset classes and turning them inside out, short term as well as long term. And there's another page that shows the annual return of all of these different portfolios. But here's my question for you guys. If I am looking for the best unit of return per unit of risk, which of these portfolios is the best, is at least historically has done that, given the best return per unit of risk?
Depends on how you define risk, or how you define the unit of return per unit of risk.
Well, we just talked about the
Sharpe ratio and the Sortino ratio both kind of do that. Standard deviation is an indication of volatility, which some people consider risk.
Okay, let's use, I think that Chris was just using the Sharpe ratio as a way of measuring that unit of return per unit of risk, which would suggest that, and the higher the number, the better the return, correct?
Correct.
Okay. And so
per unit of risk, right?
We have almost a tie, or there are, looks like the worldwide all value is good. The US all value is good. And the two funds, it's interesting, the combination of the half S&P 500 and half small cap value, those would be the better performers here. Anybody want to say that the US 4 fund should, and the worldwide ultimate buy and hold should all, I mean, the difference between all of them is not great. Is that a fair statement?
Well, I think when if you look at the Sharpe ratios and you look across the range, the red numbers look across the range of portfolios for a given time span, in the Sharpe ratio block there, the minimum for the whole range, this is from 1970 to 22, is 0.75 to 0.81. Is that significant difference? No, I don't think so, not in my opinion. For 1970 to 1979, which is the next row down, it's 0.44 to 0.77. Is that significantly different? I, again, might argue not that significant because the numbers aren't that high to begin with. You look at 80 to 89, the blue number is 2.8 and the red number is 1.3, the worldwide all small cap value and the US all small cap value. interesting. The worldwide all small cap was the best, and the U.S. all small cap was the worst during the 80s. So that's kind of interesting. But is that significantly different? Yeah, it's a factor of two, a little bit like the decade before, but the numbers are higher. So maybe. Same thing for the 90s. The factor difference between the max and the min is about a factor of two. This time it's the S&P 500 instead of the worldwide all small cap value being the worst. Same thing in the 90s, although there it's a little bit different. They're all pretty small, but the worldwide all small cap value is 5 times as better.
So what you've just pointed out here is that if we look at the whole period, the range of Sharpe ratio is there's little difference. But if we look at 10-year periods, the differences are substantial.
Well, it does bounce around. The one thing that jumps out at me when I look at this, and I say, well, where's the most blue and where's the most red?
Yeah.
Well, the most blue is over on the right side under the worldwide all value, all U.S. all value, mm-hmm. and the worldwide all small cap value. 3 out of the 5 are there, plus the total over the whole period is there, mm-hmm. also. 3 out of the 5 decades plus the whole total. And there's not much blue in the S&P column. There is a little bit, and it is more recent, but there is a lot of red in the S&P 500 column, and there's some red out on the small cap value. So to me, what that says is that the better risk versus return using the Sharpe ratio includes a lot of value,
right?
On the right side. Some of the other portfolios, the ultimate buy and hold, the 4-fund portfolios, and even the 2-fund portfolios, they do what they said they would do. They sort of smooth the ride, or they're sort of in the middle. You've got diversification. You're not out on the edges one way or the other.
Yeah.
And so it's no surprise to me that you don't see them as being the best return per unit of risk or the worst return per unit of risk.
And one big difference between this chart and the 2-fund for life fine-tuning table chart is that this one doesn't include any fixed income. From a lot of my back testing, I know that the all small cap value in small proportion, like say 20% plus 80% in fixed income, short-term treasuries, is a very high return per unit of risk. That's a Larry Swedroe barbell, roughly.
Yep.
And the reason is you have two things that are very different from one another. You have the bonds that are poorly correlated to the small cap value, and that gives you a great benefit of diversification. And so you get a relatively high return for low volatility. But again, going back to this, what would be the highest return per unit of risk for you, for the individual investor? I think there's a lot of investors who could not invest in a barbell portfolio with conviction for the long term, because it means all of your equities are in small cap value. Most of your portfolio is in fixed income. And when the news is talking about how wonderful the S&P 500 has done, you're going to have nothing but regret and be second guessing your decision. So I would say that even though on paper that's a high return per unit of risk, from a behavioral standpoint, it's a high unit of return with a lot of personal behavioral risk for many investors. And I think that's why this question I thought was interesting, because there's so many different ways to measure risk and so many different ways to optimize it. So it becomes very personal.
The other thing to consider when you're looking at the Sharpe ratio is that it uses a standard deviation, which includes volatility on the downside, but it also includes volatility on the upside.
Yep.
It penalizes the portfolio in terms of risk for being volatile on the upside just as much as it does on the downside. And not too many people, I don't think, care about volatility on the upside. In fact, it may be a thing they like to see, but volatility on the downside is what bothers them a lot. And that's what the Sortino ratio attempts to do. The difficulty with the Sortino ratio is that there's not a lot of times there's not enough data to really create a meaningful figure. That's what NMF means, no meaningful figure. And that's because there's, in some decades, there's no losing year. And you need a losing year if you're going to incorporate volatility on the downside. So you can't calculate volatility on the downside when there's no downside during that decade.
So you expect, Daryl, that certainly by the end of February that DFA will have produced their information that you need in order to update this through the end of this year or last year, and that's not going to change anything significantly. But I know people are always interested in the latest information. Does that seem reasonable in terms of your experience with access to the past results?
Yeah, I think so. Far be it from me to tell DFA when to publish their numbers, but sooner would be better, guys, if you're listening.
Yeah, sure.
But yeah, I think by mid-February, they usually typically have them out. I checked this morning, and the only thing that is there is they do have the return data for December for the fixed income part.
Oh, okay, good.
Nothing on equities yet. So
we'll take a second. In the newsletter that went out this week, we promoted this DFA, the film about the documentary about the DFA, and then the interview with the guys up at Rational Reminder podcast of the fellow who directed and produced the movie. And your response to me when you had seen it was very positive. But why don't you just take a second and give us just a little feedback about having watched it. There's 3 hours between those two, the film and the interview. There's 3 hours. And Daryl, what was your feeling?
Well, the podcast is very different than the movie. The movie Tune Out the Noise. The title is Tune Out the Noise.
Right.
The podcast is an interview with the I don't know if he's a producer, director, maybe he's all of that, that put the movie together. And I guess he's won Academy Awards or a whole bunch of awards. It's put together very well. And I could see why he may have won those awards. But it's an interesting interview on the process of putting together the movie. The movie itself is very interesting because it basically goes through the history of the research that led to the formation of dimensional fund advisors, and then the academic research that's behind that, and some of the I wouldn't necessarily say trials, but some of the interaction they had with the establishment at the time, and getting some of their views accepted, and the resistance they faced, even in the face of the evidence. And so I thought it was a very well done. It's a lot of it's a sequence of interviews for the most part with the principals that were involved in the formation of DFA and other key personnel related to the ongoing operation of the firm. I thought it was an amazing thing. I didn't want it to be over when it was done because I found it interesting. But then I'm a nerd, so you know.
That's great, Chris. How about you?
Oh, I loved seeing. Older people in the audience will relate to this. I loved seeing all the historical computing technology, the Hollerith cards, the paper tape, the magnetic tape. It brought back memories, which is dating me. I worked with a lot of that technology back in the day, and it was interesting to think how, by modern standards, with stone knives and these rudimentary tools, people were trying to bring the world of personal finance out of the dark ages. And it was interesting to hear the story of how sparse data was, how hard it was to get the information to make the conclusions that have fueled modern finance, modern portfolio theory, modern investing. And so my comment to you, Paul, was we stand on tall shoulders, and I was very humbled by it. I was also really impressed by the intellect of the people that were interviewed. Some of the material I think I will never understand, but the key principles that will drive my investing are easy and simple to understand. And so it's a nice combination, because I think the things that most of us need to act on are very simple. The idea that the market is efficient, it's got noise, but it's efficient. And so we shouldn't get too hung up over the news of the day, market timing, all of the temptations to try and do something different. It's better just to put your money in and look away and let it grow, as long as you put it in to something that's prudent and wise. Yeah.
And it does remind me how different those who are really committed to something, how different the process is from the people who just haven't learned how to deal with the challenges of the market. Mm-hmm. I convinced a dear friend to put some money in small cap value, and not much, but some. And after probably a 6-month period, we were talking, and I asked him how he was feeling about his small cap value, and he said, "Well, I sold it. I sold it." I said, "Well, why?" "Well, it just wasn't doing what I expected." And it just, when you know the thinking behind what people like DFA, and I put Avantis in the people at Avantis they came from DFA, so they have a lot in common. But that commitment to doing the right thing all of the time, and of course, all of the time may be an overstatement, but at least that's the sense that I get. And to know that the data that we use, and it's not the only source of data we have, but an important part of the data that we use is data that was developed and accumulated from these people who have a level of commitment to understanding investing at a level that I think few have. So it made me feel really proud to be some part of it. And it also gave me a huge sense of trust with the money that my wife and I have invested for retirement, and that you guys probably have some in these similar kinds of funds. It feels like the right thing to do. I mean, that's an intuition thing. We're not supposed to be feeling, but I'm feeling really good. And I also am feeling that we have been on this discussion now for about an hour. And I had some other topics. There are lots of questions we're going to have to take up in the next get together that we have that you guys will be great on. And so thanks for doing it again. Thanks for all your work. This is going to be the best year ever in terms of what we have produced to help people, and it's because of your work that that's happening. And I want to say thank you. I talked to Craig Apple today, who is behind the creator of the lifetime investment calculator, and he's sitting there and he's excited as could be to get the final numbers so he can update his calculator so people can use it with all the recent data. So thanks to both of you for all that you do, and to Craig as well. So we'll see you guys soon. Any last words? Anything that you want to say to people that right now they're trying to figure out, do I go into the market now or do I wait for the pullback? What do you say, Daryl? In or hold?
Well, it's never the wrong time to do the right thing. So if you need to get into the market, then you need to get into the market. It doesn't matter what it's doing right now, because you can't time it anyway, in my opinion.
But I want to be careful. It's never the right time to do the wrong thing, or it's never the wrong time to do the right thing. Think about that. Chris, what about you?
Maybe I said it wrong, but it's never the wrong time to do the right thing. So there, which means
Wait a minute.
That if you want,
it's never the wrong time to do the right thing, or it's never the right time.
If it's the right thing, then you need to do it.
All right, that's good. Chris, how about you?
I don't know what the year will be like, but I'm optimistic about the long term. And I think that's where I'd like my kids to be. And that's where I'd like most of the people listening to us to be. I think, Triumph of the Optimists. That was the title of, I think it was Ibbotson's book on long-term investing. And I think that is the story of investing. For the long run, be an optimist. Humanity is incredibly ingenious. And I'm so happy that every day millions of people are going to work for people who hold the total market and are working hard to earn a living, to improve the world, to increase their earnings, to beat the competition. I think the future should be bright in the long run. In the short run, I have absolutely no idea. But I would like to ask anybody in the audience who has feedback on the portfolio configurator,
great,
to give me feedback in the comments, or send us a note. I'm always trying to make it better, and I really appreciate them listening too.
Super. Thank you both, and thank you for joining us. You're the reason we're here, and the more we hear from you, the better we know what to do. So thanks to those of you who do take the time to sit down and give us suggestions. So let's have a great year together. Thank you.
We're just winging this today, right? Because I have no idea what.
Paul is the master of ceremonies. You and I are along for the ride.
Yeah, I've got nothing to contribute today. So,
well, I'm sure you will.
And I see, you got your head on your shoulders, so you brought something to share.
Yeah.
So okay, gentlemen.